Major support for these broadcasts is provided by New York Community Bank, Chase Commercial Term Lending, Chelsea Lighting, Capital One Bank, Perfect Building Maintenance, Genova Burns, Giantomasi and Webster, Kilroy Architectural Windows, New York's Window Company, the Wyckoff Group, Greenberg Traurig, LLP, M&T Bank. Additional support is provided by Ackman Ziff Real Estate Group, Bank of America, Merrill Lynch, Briarwood Organization, Bruce Mosler, C.B. Richard Ellis, Colliers International New York, LLC, Cushman and Wakefield, Dime Savings Bank of Williamsburg, Douglaston Development, Levine Builders, DDG Partners, Friedman LLP, Accountants and Advisors, Flushing Bank, Investors Bank, James D. Kuhn Real Estate Center at Syracuse University, James Orphanides, Centurion Holdings, John Katsimatides, Red Apple Group, Madison Realty Capital, Margolin Weiner and Evans, LLP, Certified Public Accountants and Business Advisors, Massey Knackle Realty Services, New Banks, Meridian Capital Group, Newmark Knight Frank, Sterling and Sterling, SJP Properties, Stonehenge Partners, and These Friends.
Here we are, it's September of 2012, and you know, the market is at the highest it's been in a couple of years, and everybody thinks that the world is great. Since most people look at me as the eternal pessimist, I've brought together the optimist today to talk about where they see the market at the end of the year and where they see 2013 from all different aspects of the world of real estate. My guests, they include my long-term person who's been on my show more than anyone else over the past 12 seasons, Bruce Mosler, who's the chairman of global brokerage at Cushman and Wakefield. Jay Shah, who is the CEO of Hersha Hospitality Trust. Bruce Schanzer, who is the president and CEO of Cedar Realty Trust. And last but not least, another individual who's been here quite a bit over the last 12 seasons, Ken Bernstein, who is the president and CEO of Acadia Realty Trust. So you're the retail, Bruce, your office, and you are hospitality. Of all those markets today, where do you see the greatest opportunity? Is it in those rooms that are going to be rented over the night? Is it going to be the office market? Is it going to be suburban retail, urban retail, you know, grocery anchored shopping centers? Where do you see the office market? It's been up, down. What do you see in the local market, in the region, Bruce?
You know, Mike, I characterize it this way. I think what we've seen over the last couple of years is a very profound bifurcation in the market. The gateway cities have done well in the sense that they've been the first to recover. Capital has poured in. The United States is a safe haven. New York particularly has benefited from that. In the office sector, at the end of 11, we saw a fall off in the sense that I think that we began to see some of the challenges that we knew would arise occur. So in the office sector, CEO, I think, confidence waned a bit at the end of the last quarter of last year. I think we've seen a continuation of that this year. Just to give you perspective, we had this time last year 21 million square feet absorbed in New York. At this point, this time this year, it's 15.1 million square feet. That's roughly 30% off.
And if we also look at that, of the 30% off, a substantial amount of those leases were large renewals.
Yes, but here's where I define the marketplace today. Clearly, until we see a little more clarity on the regulation, on the regulatory side, we're going to continue to see the financial services struggle, although it's relative compared to our friends in the Euro sector. I think we've seen the tech sector, on the other hand, boom in New York. So if you look at what has really gone well, in the Midtown South area, vacancies at 6% and dropping because that's where people want to be. Midtown is at 10% and probably stabilizing. But at the end of the day, I think this is about CEO confidence. And I think there's going to be a little pent-up demand towards the latter half of this year. The last quarter will probably pick up slightly as people make commitments. Hovering over all of this is, I think, the uncertainty in the Euro sector, the fact that China's slowing down.
And there's also an election. And
there's an election. So, we need to push through this. Things aren't bad, but they're certainly not booming at this point.
You brought up the tech market, and you talked about, a lot of the tech market is in the Midtown South, and an area where Jay is going to be opening up a fantastic hotel on Union Square. They call it 4th Avenue. Very few people would realize 4th Avenue is Park Avenue South over there. But on the corner of 13th Street, you're going to be you're opening up momentarily, maybe in a couple of months.
Yeah, a couple of months.
But Bruce's comments with regard to the tech business and also the CEO confidence has a lot to do with your business in certain markets. Especially, we were talking prior to the show, you had mentioned that even though the Philadelphia market is even doing better than the New York market in certain aspects, right?
Yeah, no, absolutely. I'll talk about the Union Square property. We're real excited about that, and it dovetails nicely with what Bruce just said. As a hospitality market, at Park Avenue South and the area around Union Square, when we look at the economy generally, obviously GDP's been real sideways and sloppy. The bright spots have clearly been, it comes down to healthcare, energy, and tech. And I think we're seeing a great, we're seeing a great pressure from a lot of the tech businesses that are filling up Midtown South and Union Square area. And because of that additional corporate demand that's coming into the market to add to what's already become a 24-hour submarket, we think that Union Square market, it's a great nexus between Midtown East and the downtown office sector, but it's creating a lot of its own primary demand, and so we're really excited about that asset.
Well, and one thing I think we ought to remind ourselves of is we've had tremendous infrastructure investment along the west side between the High Line and the 7 Line, and this has not come about by a miracle. It's been through strong investment and a vision by the city. We have to give the mayor credit here. This is something that has occurred.
But which also relates that we have one election this November and
That's
we have another election the year after.
Right.
Now, you bring up, we were talking about healthcare, and prior to the show, Bruce, we were talking about, in the Union Square, you have ambulatory health, which has become a very big thing. And, Bruce Schanzer, because we have two different Bruces over here, okay, was talking about you have a number of shopping centers, suburban, okay? Ken has suburban, but he also has urban, a substantial amount. That a number of them, let's say in the dark centers where, maybe a store went out of business or there's been a change of change of operation, you've been replacing them with healthcare. Has that become a big item, do you think, in the Cedar portfolio, or do you think it has a great potential, maybe because of, the new healthcare bill and so on?
Well, let me just clarify. We had a couple of ideas there. One of the things that we're doing at Cedar is, to the extent that we have anchors who no longer are operating but continue to pay us rent.
Like Shah.
Like a Shah is a great example. We've decided that it's better for the center as a whole to actually unwind those leases. So we enter into an agreement with the anchor tenant. They'll pay us something to end their lease obligation, and then we'll release that space to a new tenant. We just did it recently with a Walmart neighborhood grocer, where what we did is we literally are getting slightly less rent, but we're dramatically improving the credit quality.
Tell me, and I think it's interesting, especially since each and every day you hear in the press or other things, Walmart. What is the Walmart neighborhood center compared to what a regular super Walmart is, and so on?
So, everybody's familiar with Walmart, of course. They're a leading international retailer. they've always wanted to get into the supermarket business. I'm not sure to what extent you've seen them in your portfolio, but our centers, if you were to describe their demographics, they're blue-collar centers, and they really are very consistent with the kinds of demographics that Walmart really tracks. And so one of the things that we have engaged with is an active dialogue with Walmart as they endeavor to get into slightly smaller format, more focused formats on supermarket, on grocery, on consumer non-discretionary, and we think that that works very well.
So how large how large is a traditional store in this? 55, 50, 60,000?
Well, it varies a little bit. They don't have as strict of a prototype as they do, for example, with their super centers, where they have a very strict box size. They've been in the interest, for example, like the illustration that I just gave you, what they're doing is they're actually going into second generation space, right? So obviously they're constrained by whatever the size of the box is. And so they have rough parameters for what size they want their store to be, but they don't have a set prototype that limits where they can go.
And is the majority of this grocery, or is it?
Yeah, so this is a classic. They're competing with other supermarkets, and so their supercenter business, of course, has a grocer component, and Walmart is in fact the largest grocer in the United States, if you think of it in terms of the groceries that they sell. What they've decided to do is go into a dedicated supermarket business in which they actually have smaller format stores that are just supermarkets, like any of the supermarkets that we think of. Now, that, just to go back to your point about healthcare, one of the things that we are seeing as a use, more of a smaller use, not really an anchor use, but more of a 10,000 to 15,000 square foot uses, we are seeing medical uses in strip centers. So we're seeing people who drive up the same you would go to a pizza store. They'll go and they'll get an outpatient treatment, ambulatory care, and that's one of the things that we're seeing. That's sort of a trend that's happening in the healthcare space in general.
Yeah.
Ken, how do you see in your market today, the opportunities in the different areas and the new people who are going to come out there and the different tenants?
Well, to go back to what Bruce originally said, we're seeing a bifurcation. The majority of our assets are in 24/7 live, work, play cities environments, ranging from DC through to Boston, downtown Chicago. In those locations that we own that are very strong from a retailer's perspective, rents are healthy, the retailers are doing well, and values are up. In weaker locations, either in our portfolio or just generically, it's tough because the consumer is still having a hard time getting on their feet, and the retailers thus are responding in terms of a hard time for them to expand. So we see this bifurcation. In those markets that are strong, retailers are facing two interesting challenges that create opportunities for us. One is e-commerce is not a cyclical issue, it's a secular change. And a lot of our great retailers are realizing that multi-channel or omni-channel retailing is the future. And what they want to have are great locations that also are complemented by e-commerce. So for those kind of markets where we can own that kind of real estate, the pricing power as a landlord is very strong. And it's less of a generic experience for the shopper. It's about not just being able to shop at that store, but it's a branding opportunity for the retailer. It's about order fulfillment, pickup, delivery. It's about showroom, et cetera. And then from the pricing perspective of value of real estate, there's a lot of risk out there, I agree with you. But real estate is to some degree in a sweet spot, and especially I think US real estate. There's all this risk in the world and it's legitimate.
I agree.
I think we should all be very concerned about a bunch of issues, but the opportunity to have an attractive going in yield, or in the case of public companies, an attractive dividend with growth should be appealing to a lot of investors.
Make him feel good. He's owned by a public company, right?
And
we're private.
And Bruce has, I'm
You're
sure,
private.
plenty of dividend.
A public company has a majority interest in us,
Okay.
which I effectuated in 2007.
Yes, I remember.
That's correct.
That's when they let you go on a plane to Italy.
That's right.
So you hear.
What a memory.
Okay, so here we have a couple of interesting. I had just recently read this article about e-commerce sales increasing, which relates to exactly what you're talking about. But e-commerce has a major effect on your business in a different manner. I mean, how much business comes via the internet for you today, and how much, in generically, the Pricelines or the Expedias, and how much is coming directly from the Hersha site, or the Hersha, the HHM site, which is the baby sister site, we'll call over there.
Right.
And what effect is that? And also a lot of it is what Ken just brought up with discretionary money. If people have less discretionary money, they have less discretionary money to travel, to spend money in hotels, and so on.
Well, it's interesting. When we look at it, and let me talk about the industry right now as it's going through its recovery. So the hospitality industry has had, not dissimilar from the other sectors of real estate, a very bifurcated recovery. So when you look at the major gateway markets in the U.S. and you look at what we'll call the wealth island markets in the U.S., you've seen a much more robust recovery. Is it as strong as it has been in past recoveries? In some markets it is, in some markets it's not. But still, generally pretty good trends. What we're finding is that the consumer confidence and business confidence has been somewhat lacking through this recovery, and because of that, you're not seeing group business coming back as strong. But what we call corporate transient and leisure transient, which is individual travelers traveling, has been really the highlight of the recovery. E-commerce has been, across the last 2 cycles, e-commerce has become a real major consideration in distribution channels within the hospitality sector. The electronic channels, which we sometimes refer to as the OTAs, online travel agents, have taken more and more market share. What we find is that when demand is somewhat soft, so when you're in when you're in the depths of a down cycle, so take 09 and 2010, you see a higher percentage of rooms being booked through the OTAs. And as you start seeing demand returning, you're able to kind of you're able to control or limit how much goes through the OTAs. The OTAs are generally, for the hospitality sector, not the most desirable way to sell rooms. They come along with very high commission rates, and it's generally a discounted room. And so if you can rent a room for closer to your rack rate, that obviously is the better and more desirable execution. That being said, the OTAs have all been extremely useful when used strategically and managed properly. So when you've got periods of low demand, even across a week.
If you really, you can look at that also in the concept for both Mr. Schanzer and Mr. Bernstein over here with regard to pop-up stores.
Right.
Taking the situation of, hey, we might as well take the space and put a pop-up store. It was just reported that Microsoft, before the end of the year, is opening up 32 stores. Now, certain people, including yours truly, thought that these were going to be 32 new stores, but a good number of them are pop-up stores,
right,
similar to the Rickies, in the Halloween idea, taking some space in more of an urban, a better
Ken never
location.
put a Rickies in one of his pop-up stores.
Well, there is.
Wait a second. If it was
kidding.
the right situation, and that's why you have people here who can access different things, which is what I'm trying to bring up.
Right. Well, so I'd make a distinction. There's really 2 different kinds of pop-up stores. There's those that great retailers are using to immediately expose a brand or a new concept or a sub-concept.
Which is exactly the Microsoft concept.
The value proposition both to the landlord and the tenant very well may not be about the profitability of that location.
Right.
Right? It's more about branding. It's more about...
For both parties, right.
Right? And then you have some very profitable Halloween stores that the tenants only will open if they will make a profit. Us as landlords will only do it for those right reasons. And that's going to be a niche business. That's very different, I think, than some of the hotel trends that are going on, where online pricing is changing all of our businesses because the consumer has so much better information.
Yeah,
Would you agree?
Absolutely. It's complete transparency.
I have a question. There are online pricing for offices, and is that having an effect? Is the office consumer also looking at pricing? Are they doing more research today because of the sophisticated information that the co-stars, the Reeses, and the other situation over there, Bruce?
The short answer is yes, but the longer answer is that the office consumer has been a much more educated consumer for the better part of 5 years, I want to say, even beyond that, because as the cost of officing went up to be one of the top three, be it employment and technology in office, as the cost rose, people became a much more educated consumer. So we are dealing with the C-suite in almost every instance when it comes to executing either a long-term strategic plan or even a one-off transaction on behalf of a corporate. We're dealing with the C-suite. I just want to make one point, because I think we need to put where we are today in perspective. We are in a very different place in 08 and 09. We have much healthier corporations. So when we talk about the consumer travails today, and they're clearly, we have a high unemployment rate, and that challenge continues, but we are consuming, no matter what we want to say, at a much higher rate. And just to your point, look, in several years ago, Cushman Wakefield cut back on its corporate get-togethers. Today, we do what we have to do, but we know we have to do it to get our people together. So it's a different place. Just as I would tell you that I think in the next year, when you look at what's happened in the office market in terms of cap rate compression in the gateway cities, and I'll just stick with New York for a minute, we're back to record pricing. When it comes to cap rate compression, it occurs because there's still so little office market product that comes online. The fact that we allowed the banks to I think, ease the mark-to-market, which was a very wise decision, has allowed them to be careful and thoughtful in how they put product back online. In general, I think what we're going to see, because there's a dearth of product in the gateway cities, is we will actually see capital push towards the secondary cities, but those that are defined by, for instance, Houston and oil. So we will see, I think, capital push towards the secondary cities, the major secondary cities, in the coming year.
You're already seeing it in hotels.
It's happening.
Yeah, in hotels.
Happening.
You know, that's where you can get the yields. That's where, that's where you haven't seen the cap rate compression. So you see a lot of the private equity players moving into the secondary markets.
Yeah.
You bring up a number of questions, and Bernanke just enacted against another situation, yes. and it relates. Okay, I have 3 publicly held companies over here, who access the capital market both for long-term debt and short-term debt situation. Are you all taking advantage in locking in long-term rates? Or are you still like some of my residential people when I do the residential show? Rates are going to go down a little bit more, so I'll wait. And, or as Ophi or Denny would say to me, you told me to do it a year ago, and now I'm paying 0.75% to more. Are you locking in long-term rates?
Yes. I have proven time and again to be profoundly lacking in my ability to pick interest rates. What we're pretty good at is leasing space, and when we sign leases, they're for minimum of 5 years, often 20-year durations. So we focus on match funding, and if we're doing our day job well, buying right and leasing correctly, then we should match fund.
I would really echo Ken's comments. I think that the responsibility of any of us is really to enhance the value of our assets and then not be irresponsible, or to be responsible, to put it positively, on the financing side. And so one of the things that we've been very focused on is really making sure that we maximize term in this historically low interest rate environment, and not hope that maybe things will get a little bit cheaper, but really just term out as much as possible. So for example, a company like ours, we're a relatively small company. We have dramatically improved our balance sheet, although we still have some work to do. But we were still able to access, for example, perpetual preferred in the mid-7s last week, literally $100 million for a small company like ours. We've done significant amounts of 10-year term loans in the 4s. Sure. Which is just extraordinary. And these are the kinds of things that when you think about what that will do, I mean, this is 10-year or perpetual paper that literally will drive earnings for years to come. And this is really an opportunity that we have. And again, to echo Ken's point, because he's certainly done this longer and more successfully than we have, although hopefully we'll be able to emulate him. What it really comes down to is you have to really be disciplined and just take advantage of the opportunity when the capital presents itself, and not try to time it perfectly, but just time it well and be disciplined.
I think picking the absolute bottom would be a fool's errand, but I think every smart guy knows that you're pretty damn close right now.
Bruce brings up, the situation of opportunities, with government and different times. Part of the benefit of the retail world is that the banks tighten themselves and saying, hey, if Bruce or Ken wanted to build a shopping center in the suburbs, I'm not talking about urban, because you know my opinion that urban retail is great, no matter where, be here, Chicago, Boston, something like that, that you can't build a new shopping center in the suburbs for a new kid in town or without a tenant in place today. Now, that is different back in the hotels. Are we back to those days where, any person says, I found this garage, I'm going to knock it down, I'm going to build a hotel, are we seeing that again?
I don't think so, and I think there's good reason for it. Our portfolio is primarily concentrated Boston, New York, Philadelphia, Washington D.C., Miami.
And you have Miami now,
and
right?
yeah, and Miami, and I'll tell you,
that's for you,
even in
Bruce.
those markets, which are which
visit.
yeah, it's a good place to visit. And even in those markets that are just what you would call the gateway markets, A+ markets as far as hotel dynamics are concerned, you're still not seeing lenders coming out with any sort of robust offering for developers. And I think when you think about it, it kind of makes sense, right? So you've got, say a hotel loan today is going to be generally a pretty conservative LTV. So, say you're getting it at 60 to 65% of value today, which is light, compared to the last, to the tail end of last cycle. And you're at 375 over LIBOR. You put a swap on it, you're at 4 something. But take it from the bank's perspective. At 375, they're able to make a 60 to 65% loan on a cash flowing asset. So for the additional 100 or 200 basis points it's going to cost for a construction loan, why, with all of the uncertainty in the marketplace, would a bank want to take that kind of risk?
And the equity also has to say, do we really want to put a shovel in the ground?
Yeah, that's
Because
absolutely true.
Remember, we're all taking the risk and putting in that 40, 50% to make it work. So you are seeing more.
And I'm particularly more circumspect with hospitality development. We're a transient business model, so our leases are all a day long.
Right.
Which is great. Which
Well,
is great in an
you also
up
get to
market.
mark the market, right?
Right.
And we
An
mark the
up
market, right. But to count on a trend to last in an uncertain market like this, I think that's a pretty aggressive position to take. So I see all these guys running around throwing up hotels right now, and I'll tell you, it might be easy to underestimate the power of the recovery in the hotel market, but it's very easy to overestimate how you're going to be able to harness it, capture it, execute it, and make it work.
And these two gentlemen have seen that also in the retail. Everybody thought that you can build a retail shopping center anywhere, and we do well. But I think we've really got a good perspective on where we see the world today. Everything is predicated, elections, economy, and so on. And hopefully in 2013, I'm positive in 2013, you'll all come back and we can continue our discussion. I'd like to thank Bruce Mosler, Shah, Bruce Schanzer, and Ken Bernstein, and I'll see you next week.